That's the Swordsman here. It's January the 3rd, 2023. Uh, I see that metal price futures are having a great start to the year. And obviously, I mean, you can immediately see on Twitter, etc., people are getting excited. Um, because why not? I mean, if this is the first day of the year, you already have high hopes, like most, for a new year, and you see a start like this, everybody gets, of course, excited that if this is the first day and it's starting off like this, then who knows, the sky is the limit for the year. Anyway, and I I found myself looking through a bunch of juniors. I have a watch list that's, I don't know, 50 names long or something. And I come up with ideas now and then. And I kind of have, which I've had for quite some time, opportunity fatigue basically, because everything looks so cheap. And I could make an impulsive case for 40, 50 juniors, which I actually think a lot of them, if I held them for 2 years, I think the average junior, even the ones that I don't own but are on my watch list, I think they would do well just based on where we are starting off today in terms of sector valuation. And then again, you see on Twitter, people are excited. Silver is going up quite a bit. You have other metals performing well, as you can see also. And it just, you know, hit me that at times it can be very chaotic. Thanks to all the different impulses we get, and daily volatility, which brings either daily fear or FOMO. And 1 second. And it just got me thinking, like, I mean, why do most people underperform? That's thanks to volatility, or because of volatility. And still, it is obviously our main weapon if we want to outperform. And again, it's like when I find myself looking at some junior, and somebody speaks positively about a junior, and maybe you know the medal which said junior is exploring for is up, and you read someone saying, hey, this company, they have this amount of ounces, or they're drilling this target, and you look at it, and at face value it's very cheap, so you're like, yeah, okay, I would like to buy that, just based on an impulse. Basically, you just have a quick look. Emotions are high, metals are doing well, everyone is bullish, and you immediately want to punt basically. uh, and again, I don't know how many companies I'm like, that looks like a buy to me, that looks like a buy to me, that looks like a buy to me. And sure, that might be true, uh, based on where we are, the valuations, etc. But how do we have a consistent strategy? How do we actually ride out the volatility? Because one has to keep in mind that, okay, let's say metals finish up today, like they are up right now. You will have impulses that are obviously, bullish. You want to buy stuff, and you can't help yourself from kind of, thinking like, hey, I mean, if silver trades like this, and if silver goes up to 50, because like always, you have a good update, people are immediately starting to talk about upside targets, like, you see more shorts of $50 silver, and maybe some long-term shorts of like $300 silver, etc. And from that perspective, almost every silver junior, for example, makes sense. Because if that were to happen, silver juniors would go up a lot. If that were to happen, and we don't know the time frame, etc. So let's say you buy something based on that impulse today. You're bullish, everyone is bullish. You look at a company, hey, that looks actually cheap, especially if silver goes to price X. But then comes the next day, and silver is down. And all of a sudden that impulse is to sell, because your whole, or most of your reason for buying that punt the day before was because you were all excited about where the price of silver was going to go. So basically, let's say 70% of your conviction is just based on where silver is going to go, and if silver is down and people start posting charts of downside targets, etc., you'll get immediately rattled and possibly sell. So in that case, you probably have bought high and then shortly after you sell low because, hey, my case is not playing out. And I mean, that's what I think is the hardest part, to fight our impulses every day, all day. In this volatile market, we are getting bombarded by noise, and we have impulses. Since we're a human, we get carried away in either direction, etc., etc. So I just thought about some pointers, let's say, because let's face it, I mean, a good strategy is a strategy that is not only rational but also followed. Because if I buy a junior today, based on a solid case, or I mean the case is solid, but then I end up selling because silver is down or gold is down or whatever, or I think gold is going to go down for the next month or whatever, that doesn't typically line up with why you bought it in the first place. Because if it is a solid case, meaning there's a lot of alpha there over the next X amount of years, what does it matter what gold or silver is doing today? That's not even the reason why you bought, but it might end up being the reason why you sold. Which means that the buy condition and sell condition don't make any sense. They don't add up. You can't, I mean, if you're a trader, you can't really, I mean, you're basing everything on head and shoulders, and you have a target price that way, and you wait for it to break out, and you don't really care about the fundamentals. So, I mean, you can't really, I think, have a good long-term results, let's say, if you mix the buy and sell conditions, or you shift strategy. Like, yeah, you bought it for technical reasons and then you're selling for fundamental, etc. I mean, they don't match. Or yeah, exactly. I mean, you have a good case. Oh, I bought it because it's super cheap. I think it's going to be trading a lot higher in a year. And then in the short-term chart, it breaks down from something, and you sell out. I mean, again, the reason you sold doesn't even match the reason you bought. So that is, I think, one of the hardest parts. Again, shielding yourself from all the noise, and thus be able to have a coherent strategy, day out, week out, day in and day out, week in, week out, for months and years, etc. Sure, you can mix in some technical analysis, etc., but you still have to know what you're doing. Let's say why that applies in that particular case. Anyway, first of all, I would just like to show this chart here. Running on empty, LME inventories have plunged to the lowest levels in at least 25 years. I mean, you can't make up a better scenario. And I talked about this in a video a few days ago. It's like, okay, when you have this kind of shortage of supply, if we don't go into a global recession, or if we even go into a global recession, and the governments and central banks and China, etc., keep pulling demand forward, there's going to be higher commodity prices, because there's less and less metals to go around, and if they have more demand for that, obviously the price per ounce and whatever is going to go up. That's why, I mean, just looking at this chart, this is probably the best time to be in commodities in at least the last 25 years. But if they're not able to, let's say, save the global economy, or the global economy goes into a recession, etc., and this whole, fiat monetary system kind of blows up and we have some big reset. I mean, obviously gold and silver would do wonders if we had a monetary reset. So that's why it's like I think commodities is the place to be, for mostly fundamental reasons, and the miners are my favorite choice, simply because valuation, they don't reflect this at all. The junior miners reflect a world where there's plentiful supply, and especially future supply, and they're sitting on the future supply, and if they're trading at 8-year lows, they're basically saying, yeah, Mr. Market is saying future supply has not been this valued less than this in 8 years, which is obviously not the case. I mean, just going by this chart, future supply should be at the highest value in 25 years. Hence, the market is not a rational pricing mechanism, especially nowadays. It's a short-term momentum monster, basically. So we can just, imagine what could happen if we have a great shift into the old economy, and people start to appreciate commodities more. I mean, now most people who have actually or know the sector are even out. I mean, you can see the volumes in a lot of juniors. It's almost non-existent and has been for quite some time, and valuations are very low. So there's not enough. I mean, even the people that know about the sector have, been fed up. But if they get back, and then sometimes maybe the masses get in when valuations go higher and funds can actually enter the mining companies in a larger way because the market caps are higher, etc. I mean, you can just imagine the perfect storm in terms of upwards revaluation. So I mean, at the end of the day, I think physical gold and physical silver is the hedge to the entire mining portfolio, and the gold and silver miners are hedges to the, let's say, base metals and battery metals juniors I own, and the battery metals and base metal juniors are hedged to the gold and silver juniors. There might of course be a scenario where they all do very well, just based on I mean, there's a good demand for both gold, silver, and obviously the supply of used commodities, base metals, is at 25-year lows pretty much. So it's like I have no idea how anyone would go into crypto at a time like this, when you have actually real scarcity in real stuff, and you would pick artificial scarcity, which is not even real scarcity. Sure, I mean, there's the whole Bitcoin blockchain, you can't create more Bitcoin, whatever. Perhaps, I mean, that might be true, but it's like, if you have the biggest layup in real assets ever, it's like, I don't know how high my conviction had to be for Bitcoin to think that's a better risk reward. That's just my opinion, of course, and I haven't touched crypto at all. And especially now, I don't see probably less of a reason than ever to actually go into something artificial. Anyway, back to the original point. As I write here, impulses, daily volatility and chatter affects us and how we look at companies. If we are bullish on metals today, we favor one kind of stock, and if we are bearish tomorrow, we will favor another stock. Basically, we favor beta when we get FOMO. We do not favor beta when we are fearful. This leads to erratic behavior and incongruity, which I think is the main culprit in regards to what makes majority of people spelling error of people underperform an index. So I just thought about, okay, what kind of mental model would you have that has the best odds of shielding you from the daily noise and keeping your strategy coherent, every day, which turns into the long term eventually. Because again, it's like, in my opinion, the worst thing you can do is to constantly shift focus, reasons to buy, sell, etc. Because at the end of the day, then you end up like everyone else. They don't really have a case. They end up buying high, and then they sell low, because they're, I mean, most people again become momentum traders, and they go on impulse. If they're bullish today because prices are up and people are bullish, they're going to be buying. If price go down, they're going to project it going down forever, and everybody is bearish, they're going to be selling. So just again, you're just the last sheep basically, in either direction. Okay, so I just did some self-reflections, like, okay, because a lot of a big part of investing is just knowing yourself. That's why I said that I don't do too well with beta, because as soon as metals are up, I want to buy beta. But tomorrow, if metal prices are down, I want to sell beta. Which, if you just did that consistently, it means that you would end up buying every short-term top, selling every short-term bottom. And your returns over the long term are going to be, very negative. So what are some things, like, how should you think, and what frameworks should you use in order to not fall into the, impulse traps that catches 95% of people? First of all, a longer time frame. By definition, it makes daily noise look like noise, because your point of care in terms of what something is priced at is still, let's say, a year away. So if you have a case like stock X is at 80 cents, and you think that, hey, I think these guys will create enough value, etc., that I think my case is that this stock, which is priced at 80 cents per share today, is going to be trading at $2 in a year. In that case, if it goes up to 85 cents tomorrow or down to 75, assuming you have, again, a good case, and you know why you think it's going to trade at, a base case of $2, that, I mean, one day's price change doesn't change a thing, really. It's just, if it goes to 75, you think, hey, I'm going to make even more if I add some. If it goes up to 85, okay, I've already made some paper profits, so there's a bit less, but there's still room to grow until $2 in a year. So it's like, one day of volatility is just one day out of 365 on the journey to your eventual price target. By definition, I mean, that's what you really that should keep you focused on, the big waves, the big trend. That, hey, I don't care about 3%, I'm after, 130% in this stock. We're not even close to that. And if we go lower, you're just like, okay, that just means I'm gonna make more later on. So if that's your time frame, it cuts out a lot of noise, because in your mind, the case is not over until a year from now. That's when you can evaluate the investment, let's say. So by definition, daily swings becomes just noise, because it's just, let's say, one part of 365 on the journey to a 1 year hodl case. Neutral metal price assumptions. If you can make a very good case for a company under the assumption that metals will go nowhere, your conviction / thesis is less affected by daily swings. This is a very big one, I think. Because if you're bullish on a company under the assumption that metal prices will go nowhere, it suggests that you do actually have a good alpha case. Meaning that if you're right, there's a high probability that you will have good returns if metals don't go anywhere over the next 1-2 years. If metals do go up, there's a good chance you'll make a lot of money. If metals go down, you might end up with a small loss or maybe even a neutral return, which is still outperformance. So it basically, if metals are up, you're gonna do great. If metals are flat, you will do well. If metal prices go down, you will hopefully do okay or not lose too much. That is either outperformance or at least very good results. Because let's face it, a microcap company in a total FOMO environment, if metal prices run, yes, that alpha stock, serious business, good case, might not outperform a nano cap. But you wouldn't complain if you had like 300% return, or you shouldn't complain if you had 300% returns, while some micro capper goes up 600%. Because in either of the other scenarios, maybe, if metal prices are neutral, maybe the micro capper would be down 50%. In a very poor market environment over 2 years, maybe the micro cap company will actually be bankrupt. We just see what actually happened. But as an investor, we have to figure out and think about every possible scenario. Because every possible future scenario is still on the table today when we're making our actual decisions. So if you are bullish on a company, and even if, again, that should play into your case. Okay, assuming no help from the price of metals, if you think this is a good company, that's gonna allow you to have the conviction even if metal prices go nowhere or slightly down, because in your opinion or in your mind the case hasn't changed. They're going to create, let's say, 50% of value over the next year. That's what you would be bullish on, more so than that, because more so than the actual metal. Because you're thinking about, you're greedy. Your greed comes from a future view of what the company is going to look like, not where silver is going to trade or gold is going to trade. That means basically, like I said before, have the conviction like it's a bull market. I mean, I love commodities because I think they're in a long-term bull market, but I try to pick the companies, especially the big positions, under the assumptions that metal prices will stay where they are. If I'm bullish on a company over in a neutral metal price environment over the next 1-2 years, that means you probably have a good alpha case. So that keeps me bullish. Thinking about the catalyst 6 months to a year from now, for example. That doesn't change. The catalyst doesn't go away. Ore body doesn't go away just because price of gold or silver is down. So that also keeps you from doing impulsive things. Because, okay, hey, I think this company is going to create, a lot of value over the next year. I'm bullish on that future. Because now the company looks like this, but in a year or 2 years, it might look completely different for the better. So that's what you're greedy about. So, metal prices is kind of an afterthought. If they create 100% additional value in a company over the next year or two, that might have, probably more impact than if gold or silver is down 10% or up 10%. Acceptable and rational return assumptions. Not too greedy, not too conservative. If one appreciates how good a 100% return over 2 years is, then one would consistently be rationally greedy while automatically having a big edge, which would allow for such good long-term results. Why would that be a big edge? Because if you understood how good a 100% return is over 2 years, which is like 42.24, I think, percent per year, if you would average that, if you would compound at 42% per year for 10 years or whatever, what you started off with will be worth a lot more in that future. In 15, if you started out with $10,000 and you compounded 42%, over 10 years. I don't remember how much that is going to be, but it's a very large amount, and in 20 years you'll have a very, very, very large amount. uh, Still 95% of people can't beat an index. Why? I mean, one big thing is that everybody is chasing too high of a return in too short of a time frame. If, like I said before, if you said to someone, in the average junior investor, that hey, you should buy this company, let's say you can theoretically guarantee that it will compound at 42% or return 42% over the next year, nobody would buy that, because nobody in this space, almost nobody, is buying with the hopes of getting a 42% return over the next year. What is it that everyone is talking about all the time? 10 baggers. And even though 10 baggers typically play out like, 50% every 6 months for X amount of years, becoming a 10 bagger, that's not how people think a 10 bagger is made. People think a 10 bagger is made by one discovery hole, and then it just goes up 1000% within like 2-3 months. That pretty much never happens. You would get a 10 bagger if your stock just compounded at 42% per year over a few years, or I guess several years, and you would beat everyone that is actually actively looking for a quote 10 bagger. So if you only pick companies like, okay, what companies do I think at a, let's say again, a neutral price metal assumption over the next 1 to 2 years, which do I think could deliver 100% over 2 years, with the understanding that if that ends up being the case, those are very, very good results, but nobody's out there looking for them. Almost nobody buys. Either, in my opinion, people are way too conservative, and I shouldn't say way too conservative, but it's like, people buy, let's say, Barrick, etc. So yeah, there's no chance that this company, will go absolutely bankrupt or whatever. Yeah, but there's like no upside really, except for a higher metals prices. So yeah, sure, maybe it's like on surface you're kind of shielded to the downside, but you don't really have any upside surprises. So it's just tied to the metals, and just in a more volatile way, because it's higher beta than silver, or it has a high beta to silver or gold, for example. But if you actually, at all times, when you thought about your companies, like, I think if you think this company is probably gonna create or go up 100% over the next 2 years, and really having the understanding that that would be a very, very good result. If I could just keep on finding companies that I think on a rolling 2-year basis they would return 100% on average, inevitably you would get very rich. Inevitably. But nobody is looking for them because they are considered too boring, let's say, to hold. And especially if metals take off on any given day, people can't, be asked, let's say, to hold such a quote boring stock. So discipline immediately goes out the window, and they typically revert back to some other stock. That's why, again, just knowing yourself, I know that prospect generators are typically the cheapest around at any given time. They have great risk reward from a fundamental basis. I mean, some prospect generators basically trades at cash. But so at face value, you're not even taking any risks buying them. So they are, from a fundamental perspective, they are typically always the most superior plays. but I know they are too boring for me. So even though I know they are probably the best buys at any point in time, I can't get myself to buy them because I know I will uh, be too bored. So I am okay with taking more risk via, let's say, the drill bit, uh, in exchange for, hopefully even better returns. But again, I'm taking more risk. But that's just, I know I can't. In order for me to be involved and actually care about the portfolio, I can't play too safe. But at the same time, I have to stop myself from being too greedy. Because now and then I get the urge like, hey, this company could go up several hundreds of percent. And especially, if you're in a risk on mood when metal prices are up, for example, that's typically what you have an impulse to buy. The ones that could go up a lot. Always, could. But when you really think about it, it's like, yeah, but what if, yeah, if everything goes right, then that could happen. But in either any other scenario, and especially if metal prices are poor, they don't really have, a project or a deposit. Nobody will care. They probably can't get money, etc., etc. So yes, like always, when it's risk on, we focus on how much we can make. When it's risk off, we think about how much we can lose. And that's all we focus on. But to have, again, if we just kept ourselves to following these principles, let's say, uh, I think you would handedly beat an index. And you would at least keep your strategy coherent. Because what companies you like wouldn't change on a daily basis. You wouldn't sell uh, a company tomorrow which you bought today. You wouldn't care that much about short-term volatility. You would use volatility if anything, because again, if you have a fixed base case in a year or two from now, then you can only look at a change in price and oh well, it's up today, so maybe I'll buy less of that. Well, it's down to tomorrow, and then I'll buy a bit more of that, because you're constantly just comparing current price to the future case, not price itself. Like it's going down today, so I better sell because I think it's going to be down tomorrow as well. That's not a good strategy. But that's the kind of stuff we get impulses to do. When things go up, people talk about higher metal prices. We want to be risk on. So all of a sudden we might sell a really good case, an alpha case, buy a high beta play, and then we have 2 weeks of downward action in the metal prices, and all of a sudden we're like, oh, I was so stupid, I did a mistake. The thing is obviously to not even make, uh, let's say, make the mistake in the first place, regardless of what the metals do. Because if you do sell a good alpha story, buy a beta story, and metal prices keep continuing up, you'll think, yeah, I made a superb decision. I sold this boring alpha stock that's probably not gonna do more than 100% over the next year or two. And you bought something that if silver just keeps on going, it will do very well, and you're all of a sudden up 20% and you feel super great about it. But after that, what if it goes down after that? We can't just look at what actually happened in terms of share price performance and automatically say, hey, was this a good or bad decision? It's like in poker. You can play aces, pocket aces, best hand in No Limit Hold'em, 10 times in a row, and you could lose all of those times. That still doesn't mean it was a bad hand or a bad play. It's just that, stuff happened. Just because you have a good case doesn't mean you'll have good returns, especially not over a specific time period. So yeah, I hope at least these might be some handy pointers, let's say, to have to when you evaluate your own stocks and how it might help shield you from the daily volatility, because let's face it, a portfolio shouldn't, in my opinion, change too often, if especially if you're a long-term investor. I mean, on a day with no news, by definition nothing has changed for a company. But yes, silver price and gold prices change on a daily basis, and the prices of companies typically change on a daily basis. But the case doesn't change too much unless there's a big volatility, like we saw with GDXJ rebalancing, a stock that has done put out no news, being up 60%. That considerably lowers the risk reward, because price only, value didn't go anywhere, price went up 60%. So you got 60% now, much less in the future. That's an opportunity to sell. Meanwhile, some companies that get thrown out of GDXJ might be down 30%. No fundamental change, price went down 30%. Perfect crime in that scenario would be like, sell the 60% pops and buy the ones that went down 30%. You get 60% bank right now, with, let's say, expected future return of 100% left, and you buy the ones that's down 30, which might have a 200 expected return all of a sudden. So that 60% gain, and then that might get a 200% boost in the new play. I mean, you can see how that compounds in a hurry over the longer term. And also a legit project. Can you see the company actually developing something which could become an actual mine? Because there's a bunch of companies out there. It's like, yeah, okay, this could do really well in a good gold or silver environment, but it's like, would you actually want to own it yourself? I mean, would you be happy owning it 100%? Does it actually have a shot of becoming something, or is it a pure trading sardine? If it is a pure trading sardine, you need to be aware that it's a pure trading sardine, and that's the companies I try to stay away from, because I have no conviction when it comes to beta and trading sardines. It's like Bear Creek Mining; it went up 200% from the recent bottom in just 2 weeks. That's a return worth, I mean, years worth of return in just 2 weeks. Why didn't I pile in Bear Creek Mining, despite the fact that, as I've shown a bunch of times, one of the highest beta plays, it crashes and then goes up like 500%. It's because I know what would have happened. I know myself. If I bought Bear Creek Mining, I would have no conviction, because I don't know the story well enough. I don't think it's a superb case. So I would feel like a gambler. I don't feel like gambling when I'm buying the high quality juniors. I don't feel like it's gambling at all. That's where conviction comes in, and that's why I know how I work when I go into beta and plays and trading sardines. As soon as Mel's head down, I get fearful, because I feel like I'm a dumb gambler. If prices go up, I get bullish, and again, I'm a big gambler. But the main point is that know how you will respond in like any scenario. Let's say you buy Bear Creek Mining, it goes up, I don't know, 30%. And you feel like, yeah, okay, things are starting, things are really starting. But how will you react if it goes down 20%? I know I'm gonna feel stupid at that point, because I don't see myself having an edge. I'm just beta gambling like everyone else. And I have no idea where price is gonna go tomorrow. With these alpha stories where you have a good case and you can actually kind of see in the future which news releases are gonna come out, and how that is going to affect value and how that is going to put a pressure on price to go upwards. That's not gambling. That's just solid uh, value investing, or yeah, and having good conviction. And yes, so the bottom line, regardless if you're bullish on a commodity, which I am, I'm bullish pretty much every commodity. The idea is to be bullish the actual underlying company without needing to be, quote, saved by higher metal prices. So if you find yourself buying something because, hey, this could do very well in a ramping silver or gold environment, I think you're setting yourself up to fail basically. Because the only time that really works if it, yes, we go into an actual rally and just keeps on going straight up basically. Any kind of serious correction, I think it will be shaken out and ending selling low. And when it goes up again, you're probably gonna buy higher, and maybe that's in time for the next correction. So you end up basically buying high, selling low. The only point again, or the only time I can see that really working for myself, for example, if it would be basically go straight up, so I never even have a correction to shake my conviction, which I, pretty much have no conviction. And that doesn't happen too often. Even in the big multi-year rallies, you'll have 30% corrections, 50% corrections, etc., etc. So in a volatile sector, obviously one of the key things is to handle volatility. And I just know for myself that beta in a trading sardine uh, inevitably ends up me being a victim of volatility than taking advantage of volatility, because I'll sell that if it goes lower. Whereas if I have a conviction on an alpha story, I will be much more likely to buy the lows than sell the lows. Yeah, anyway, thanks for listening. I hope you got something out of this. Bye bye.